revaluing gold, and I'm not sure how we do that exactly anyway. It's not like we're in charge of that. So I'm skeptical of that, certainly skeptical of it happening before a bust. By the way, I do have a $20,000 target for gold. It's just that I think that comes in the next cycle when we have all that money going to work. It drives, the next cycle is going to be a commodity cycle, an inflation cycle. And I think gold and silver are going to be the top performers in that, or among the top performers. So I have silver going to 1,000 and gold going to 20,000, just not this cycle.
The current economic landscape reveals a fascinating divergence between sector strengths and consumer realities. While massive trends like manufacturing reshoring and rapid artificial intelligence deployments prop up industrial equities, a stark divide is widening. More than half of the population feels entirely left out of this boom, forcing everyday consumers to aggressively deplete their personal savings just to maintain baseline spending habits. David Hunter, a widely followed macro strategist known for his bold contrarian calls and parabolic market targets, highlights that we are barreling toward a monumental global bust driven by historic system leverage. He maintains that recent cooling in CP1 and PP1 prints confirms that inflation is rolling over, which perfectly coincides with a major bottom in bonds and a definitive top in yields. Within this terminal phase of the cycle, he forecasts an ultimate vertical melt-up over the next few months, pushing the S&P 500 to a staggering 10,000, the NASDAQ to 36,000, the Dow to 70,000, and the lagging Russell 2,000 up to 4,000. In tandem with this equity blow-off, precious metals are expected to surge in an unbelievable near-term run, with gold projected to hit $7,000 and silver targeted to skyrocket from under $60 to $200 before the calendar year wraps up, setting the stage for a massive future macro cycle, where silver eventually hits $1,000 and gold reaches $20,000. Now, we present the clips from David Hunter's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold, I'm equally bullish on gold and silver. We had that great run from November to January in silver, and gold was a longer run than that. But silver got up to 122 from it had been in the 50 area when it broke out. That was a long-term breakout point. There's 48 or 50, and it just took off and basically went parabolic. Covered more than doubling in probably 150% in 3 months. And so people are you had to correct what was speculative blow off. People were just through the roof in bullishness, and you had to correct that. I thought it'd correct in a few months, but it's taken 5.5 months now. And you've gotten a lot of that speculation out of there. Certainly a lot of people who jumped in the last inning of that run. They weren't there at 50. They weren't there at 75. They might have gotten there over 100. And all of a sudden, they're down in half almost, And so that wakes you up in a hurry and turns you bearish in a hurry. So I think we have the sentiment there now, the backdrop and sentiment there now where we can come out of this. And I believe normally I'd say a parabolic usually comes at the end of a move, at the end of a big cycle move. But in this case, it was so fast and it unwound so fast that I think there's even a steeper move following that. So if you can do that in 3 months, you can see another, my target on gold is 7,000. My target on silver now is 200. So particularly silver, being where it is down just under 60, if it can go from 60 to 200 this year, and maybe even faster than the end of the year, that's pretty steep. And gold, obviously, if it can go from 4,000 to 7,000, would be an unbelievable move. So that's what I'm seeing, and that's what I expect. I realize there's lots of people out there in that field, people that follow gold and silver closely, who think they both have more to go. The breakout in silver was 50. Gold looks like it could go back 3,500. And so I can't say that's impossible, certainly, until this thing really gets turned around and you start seeing a little more upside, there's always a risk that, this is just another dead cat bounce and it goes lower. I think based on what I see in sentiment and what I see in the charts and everything, there's a pretty good chance we came down to a trend line on silver, and gold looks like 4,000 or 3,900 is a pretty good place. And ironically, and I didn't do it for this reason, but if my numbers, and my numbers may not be right, but if my numbers are right, 200 on silver to get back down to 50 would be about 75%, and it would be exactly 75%. That would be, kind of a normal in the, if I'm right about what equities are going to do and what we're heading for in terms of global bust. Silver is a very cyclical metal, and it will get hit almost as hard as equities. 75% would make sense to me. That would take you back to that 50 breakout point that all these technicians think is necessary to get going. So you could have it, but not have it now and have it later. Got down to 56 in this correction. Gold from 7,000 to 3,500 is 50%. 50% retracement would be a very normal retracement in anything, but in gold, certainly that would make sense. So whether those numbers are right or not, I didn't get to my numbers that way, but the other day I just said, oh, those are convenient, kind of places where it could correct from. So I think the possibility is that all those people waiting here for that last shoe to drop, as often the market doesn't accommodate, you take off from here and you get to those breakouts, those natural places where it should go down to in the bust rather than now. I guess my feeling is that we're too close to the bust for anything like that, because that's going to take time. You just don't all of a sudden roll out, we're revaluing gold, and I'm not sure how we do that exactly anyway. It's not like we're in charge of that. So I'm skeptical of that, certainly skeptical of it happening before a bust. By the way, I do have a $20,000 target for gold. It's just that I think that comes in the next cycle when we have all that money going to work. It drives, the next cycle is going to be a commodity cycle, an inflation cycle. And I think gold and silver are going to be the top performers in that, or among the top performers. So I have silver going to 1,000 and gold going to 20,000, just not this cycle.
Okay.
So I'll top them, but just not now. I'm thinking because the economy is slowing, and I was pretty alone out there saying I think the trend in inflation is still down. That sometime in the next few months we'll see the trend reassert itself on the downside. Well, we got that this week with the CPI and PPI, and I think the New York Fed president this morning in comments in a speech he had said it's possible we may have seen the peak in inflation back in May or June, and that we are rolling over. So, and I agree with that. So, I think it coincides with a bottom in bonds and a top in rates. And my rate forecast hasn't changed probably since we talked last. I still think in the bust you could see a 0% 10-year negative short rates, and probably the 30-year down to 0.5%. And basically it would be one last lower low in rates, higher high in bonds, before we embark on a huge bear market, because next cycle is inflation to the numbers I talked about. So you could see, probably 25% short rates and close to 20% long rates if inflation goes to 25%, the next cycle. So that wouldn't be until probably 2032 or 3, but, it would be moving up in that direction throughout that cycle.
The staggering level of debt and complex derivative products embedded across mainstream retail and institutional channels carries unprecedented systemic risk. When the impending market top finally breaks, this massive accumulation of leverage will viciously exacerbate the downside, triggering a deflationary contraction far more destructive than the 2008 financial crisis. During this initial global bust, 10-year Treasury yields are predicted to plunge all the way to 0%, alongside deeply negative short-term rates, while the 30-year bond yield bottoms out at a mere 0.5%. Concurrently, cyclical commodities will face an immediate, brutal liquidation mirroring the equity crash, Silver is expected to undergo a normal but violent 75% retracement back to its original $50 breakout level, while gold faces a standard 50% technical correction down to $3,500. This severe deflationary flush will mark the absolute final lower low in interest rates before the global monetary system is forced into an aggressive, involuntary restructuring. Now, let's get back to the interview.
I think, the economy is still surprisingly intact. I have always talked about a have and have not economy. Some people call it a K-shaped economy. And I think that's still the issue, is that, half the population doesn't feel like we're in a booming economy at all, probably more than half. And frankly, we are seeing signs that things are moving towards a recession. We're not there yet, I don't think. I know there are a few people out there saying that, based on some numbers, you could argue we're in recession now, but I think we're moving that way. The economy's slowing, but amazingly, it's still intact. You could have made these same comments a year ago, and it's still kind of pushing along. But I do think as we get closer to the end of this year, we could be in a recession. Manufacturing, because of the reshoring and all that's going on with AI, that's really holding the economy up, and that side of things looks really good, as you might see in some of the industrial stocks, et cetera. But it's the other, the consumer, half the consumer really is struggling. Amazingly, consumption's still fine, but you are seeing signs they're having to pull more out of savings to keep their shop till you drop spending going, and that's obviously can't be sustained. So jobs are slowing, but every time you think they're really going to start giving you bad numbers, they kind of pull themselves back up. So we're just kind of, I don't want to say steady as we go, but we're skating along here in positive territory on the economy side. The markets, I am as bullish as ever. I do think it comes to an end, maybe before the end of this year, but right now, my numbers are, if you go to my targets, you're still looking at more than 30% upside in all the indexes, all the four indexes I target. So, Dow, I just raised my target in my July letter to 10,000. I had been at I'm sorry, not 10,000, 70,000. I had been at 67,000. My S&P number is 10,000, and I didn't raise that one this time, but I'm at 10 there. I'd raised it in early June. I'm at 36,000 on the NASDAQ and raised that in early June, and I'm at 4,000 on the Russell. And, for a long time, I got beat up for my Russell bullishness because it lagged the others, but it has certainly caught up this year, and I think still has, good upside ahead. So what I see out there is really, I think the next few months are going to be really strong. Whether this takes, I get people on X constantly wanting me to tell them what time it's going to top, and I say it can happen very quickly because I think we're in a parabolic. If you look at the monthlies on the charts, you can still argue, in spite of a June consolidation, you can still argue that it looks very vertical here and that it's going to just get steeper from here. So if that's the case, if we don't go through a long drawn out consolidation, you can get to those numbers, believe it or not, within a few months. But if it takes longer, it takes longer. I'm calling for something bigger than just a normal recession, something that I call a global bust, is because of leverage. We have far more leverage today in the system than we had in 2008-9, and that was off the charts then. So, 2008-9 happened because of the leverage, or was, far worse than it would have been otherwise because of leverage. And this time we're far beyond the leverage we had then. And I define leverage as the debt obviously is leverage on the financial system, on the economy, and derivatives are leverage on the markets. And we've been, really since the 80s, been creating all these derivative products that are now mainstream in retail as well as institutional. And it's that leverage both on the debt side and both on the credit side and on the equity side. There's just all kinds of leverage in derivatives. so that when this thing does turn down, that leverage, both debt and derivatives, exacerbates the downturn. So kind of enhances on the upside, options and margin, if you're right, that can really give you the chance to make more money. But when things turn down, that leverage really exacerbates the downturn. So I think that's the biggest reason for something worse than just a plain ordinary recession that we have every number of years, because things go to excess in the economy and in credit markets, and they just get corrected.
The true paradigm shift arrives immediately after the deflationary dust settles, giving rise to an era defined by secular stagflation and structural asset revaluation. This subsequent macroeconomic cycle, projected to shift into full motion around 2032 or 2033, will transform into a secular commodity and inflation supercycle as central banks flood the decimated global economy with unprecedented amounts of high-velocity liquidity. As inflation parameters eventually spiral upward to an astonishing peak of 25%. Fixed income markets will experience a historic bear market, violently forcing short-term interest rates up to 25% and long-term yields close to 20%. Hard assets will serve as the ultimate performers in this inflationary landscape, driving long-term revaluation targets to breathtaking heights where silver eventually commands $1,000 per ounce, and gold solidly claims a $20,000 target. Navigating these multi-year cyclical rotations requires constant vigilance as the monetary backdrop evolves from near-term deflation to long-term tangible asset supremacy. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.